everyone. Welcome. It's Andrea. So today we're gonna see the market opens, how to trade the market opens. It was a webinar that I was about to present last week, but unfortunately, due to some personal circumstances, I couldn't present it last week. So I'm finally back and I can present finally the how to trade market opens webinar. So hopefully you will find it interesting. This is, by the way, is for everyone. It's not precisely for stock traders, but it's for every single trader and for every single asset class as well. So I have uploaded as usual the handout in the handout section. I have extra slides on, and the reason is just for you as a bonus material, as I call it. I have at the bottom of the webinar and on my slides, I have included also how to keep trading journal, how to time your entries, and some risk management slides as well, because it's something that it will help you. It will help you in general and more precisely if you decide to try to trade the market open. I think these information are necessary. So as usual, before we start the session officially, I need to go through the disclaimer warning. Anything you need, I'm here to help. So that's as usual. Don't forget to send us an email at webinars@agefm.com. It's the support team that replies on spot, along with myself and Michalis as well, the new member of market analysis team. Okay. I can see that it's capturing the sound. Okafor. Yeah, 1 2 1 2. Guys, can someone confirm that you can hear me loud and clear? Let me reply to Okafor. Guys, can you hear me, or is this something that you're facing? All of you facing a video issue, or is it just Okafor? I would really appreciate a feedback in regards to the screen and, of course, the sound. Until I get a feedback from you, I will read out loud the disclaimer warning as usual. This material is provided as general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature, is Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leverage such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. So everyone, okay, sound is fine, visible, I can hear you. Thank you very much for the feedback, guys. Oops. Okay. This is what we're going to cover today. And so first of all, let's start with the obvious. Perfect. So let's start with a bit of a basics, right? Because it's not obvious to everyone. What is trading the open? What is a market open? And why should we trade it? So first of all, guys, what is a market open? What do we mean by market open? As you might already know, okay, the market is characterized, let's say, by specific periods, important periods. Okay, important periods, and more precisely, I'm referring to the open and the close of each period. So, stock market, forex market, and etc. are traded during specific period of time, right? When you as traders and investors are able to conduct any transactions that they want. So the forex market, for example, is open 5 days a week, so it's closed over the weekend. So we can say that for forex, the market open is Monday morning, let's say, and the closure is Friday night, okay? But it's not as straightforward because globally we have different time zones and etc., right? And I will explain right now the meaning of it. But you should understand, first of all, that market open, when we are saying market open, we are referring to the open and close time of a market. If this is forex market, then there is a different open and close time. If this is stock market, different one, commodities, a different one, etc. We're gonna see later on what precise all of them. But before precisely I tell you the times in which every single market opens, I would like just to very, very briefly touch a bit the topic of what is it all about? What is it? Why some people are obsessed on trading the open? Why is so important? What does it tell us? Why the market open tells you? Does it give you an indication, something important? Why it matters? So, as I said, in general, when the market is open, the market participants can conduct transactions. However, an early trading often dictates what is likely to occur over the course of the session. That's why market open matters, because that on the market open, whatever happens on the market open, it could give us a very, very good possibilities of what it could prevail for the rest of the session. It does not mean, of course, that a trader can know exactly where the market will go, but it's a very useful information which is provided near the open and can help you determine whether the day is likely to be a ranging one, trending one, a volatile one, and etc. Okay, so it's an indication as to how the trading day will play out. That's why I put over here what it's all about. It's all about spotting any imbalances, the momentum. It's about checking volume and liquidity and volatility. So, because it will be included in our risk management. So there are people that love it, there are people that hate it, okay? It's nothing nothing is wrong on it. Okay, you might not be that kind of trader, and that's okay. What else matters? The time frame matters. Other than the time frame, it matters on how long you're keeping your entries based on the information that you gain from the trading, the open, when you investigated the market open, etc. But we're going to see all this in a bit. So, okay. Yeah, so a lot of useful information could be derived from the market open. So everything is important. All the information that we can find from the previous close until the next open are useful, because as you can understand, all the information, everything that might happened overnight, okay, when the markets were closed, either from politics, either from any economic releases that have been announced when the markets were closed, like earnings. Earnings sometimes are after hours. Any announcement from banks, from I don't know, financial institutions, and etc., upgrades or downgrades of a stock, and etc. Everything matters because they will play out a significant role on the open. Okay, so the market open, as I said earlier, is the trader's first chance to get a look at what the trading day may hold. So any information overnight, any information, international information as well, it might play a significant role in the open, because the markets have absorbed this information, and you know that they can act on by a group of traders, right? And as we move on into the open, we can see some significant changes in the sentiment sometimes. That's why we always say that you should be up to date, you should read the news overnight before the market open. I can see that audio is good, actually extremely good. Please check your end, Martin. So, yeah, always before the market open, check any overnight news, how much activity is taken, scan your charts, what happened, why it happened, how it happened, in which direction it went, and so on and so forth. The handout, Brian, is on the handout section. It's there. I uploaded it. So please download it, okay? Judge it. Is that a confidence in the move, and so on and so forth. So also something else that it also is, it justifies why the market open is so important, is the volume. So high, low, same. So the opening volume in the morning, so let's say this morning in the European Open, is significant because the opening volume is always high if we compare it, of course, with the rest of the day. So by comparing morning volume to intraday volume explains a little of the, actually it helps a bit on deciding whether it's a strong move, whether it will continue, the asset will continue in the same direction, so on and so forth. So an increased volume, generally, guys, remember that it means an increased volatility, and is likely greater change in price. Remember, high volume, right, indicates that more and more and more market participants are involved, even big institutions are involved, and there is a higher probability of daily sustainable trends. The same stands for a low volatility as well. Low volatility means that there is a lack of interest, right? Lack of low volume near the open indicates that there is not a lot of interest. So that might lead to a ranging market during the day. So this is why, this is one of the, other than the overnight information and etc. The next reason why the market open matters is the volume. Third, pre-market activity. Oops. Sorry. Pre-market activity. What going on helps plan yesterday's range. Exactly. Sorry. To see whether early market moves are sustainable. Sorry. So actually, in general, by monitoring the pre-market activity, it helps you prepare yourself or your potential position in advance, especially in the stock market. Okay. You know, we are saying that Apple declined by 5% pre-market. What that means? It means that there was a pre-market activity from big institutional players mainly. So this helps you to prepare yourself, or even to create a plan on opening a position in Apple as soon as the market opens. So if a stock has significantly rose on pre-market, then once the market opens, we're expecting to see a significant jump. While if it suffers significantly, if it had a huge decline in pre-market, that means that as soon as the market opens, it will dive. So pre-market activity matters because it helps you to prepare yourself in advance. This is only for stock market. Okay. Momentum. Is it sustainable? Momentum. Sorry. So, momentum as well. Sorry for that, just a second. Okay, perfect. We have seen volume. It can be as it gets higher level of day. Sorry. Okay, let's finish with momentum before we move on to the market opens. Also, something that I haven't mentioned, in order to gain further insights, right? And other than to see, to check as I said, the volume, to check any pre-market activity, any news, and etc. We need to check momentum, right? In order to monitor whether any potential trend or any existing trend is sustainable or not. So for gaining further insights regarding the volume and the momentum, etc., you need to use your indicators. Yeah, with this way, you're gonna have a full picture of the asset that you want to trade eventually. If momentum is strong, that means that all the above that you have checked, I mean, the signal will be even stronger if the momentum is strong. Okay, so you will not end up with a ranging market. If the momentum is low, then it might cancel out everything that you had considered for the market open. Remember, a trader needs to check volume, need to check momentum before it takes any decision. Okay. Yeah, this will help you avoid any ranging market. Obviously, if you are a short-term traders, you can still trade the range, right? But that requires short-term moves. So that will be something that you can decide after the market open as well. Also, let's move on a bit. Actually, yes, before I speak about gaps, I would like also to show you the market opens. We have plenty, obviously, right? And I would like also to show you a website that has all the global the global market opens. I mean, even Indonesia, Singapore, Mumbai, Chicago, Toronto. But obviously, the important ones and the ones that they have the highest volatility and the ones that we are seeing the significantly high volumes are these four. These are the most important ones. It's the ones that we see the biggest amount of volume. I'm referring to the Sydney session, Tokyo session, London session, and New York session. Okay? Because during these four most important market opens, because these are the biggest economies in the world as well, and the biggest exchange centers. That's why we have seen the biggest amount of volumes during these market opens. So they are the most important ones because we have big amount of volumes occurred. We are seeing high frequency traders as well, executing trades open in extended hours. That's why these four market sessions are the most important ones. For all the reasons that we mentioned, in order to catch up any information regarding an asset and for considering a potential position for that particular asset on the market open. So, yeah, we have covered of this as I said during these four precise sessions, but in general, the more precisely on London and New York, we are seeing the highest volumes, the highest liquidity, and the tightest spreads as well. If I had to mention which are the most important ones, I will say, and everyone will agree with me, the whole world agrees with that, is that it is the London Open, which is also the European Frankfurt Open. This is at 8 o'clock Universal, obviously, or GMT if you prefer, and New York one, which is at 1 o'clock, 12:30 to be more precise, Universal. Okay, Universal. So, okay, this is the local time. So you, anyway, in your platforms, these are changed automatically based on your time frame. So, yeah, New York and London, and more precisely, the clash of London and New York is considered to be the busiest time of the whole day. By default, London and New York are the busiest time zones in general, but the confluence, the clash of these two sessions is also the most important and the most busiest trading period in the world. The period when the two trading sessions overlap, so London afternoon, New York morning, is the busiest period and is the period in which we are seeing the majority of volume trading in the day, with trillions of dollars in value changing hands. Okay? So this is just examples that I have put on with highs, lows, with Friday's lows, Friday's high, and how it opened in the Monday morning, right? Boom. Just to see how important the open is, and also this is a Nasdaq, by the way, just 1 minute chart. So this very first minute on Monday morning, which is the big bullish candle, is what it had led the whole day into significant gains. Okay, so although the opening hour is seen as the open, you need a very good approach is to have to check the first 15 minutes, 20 minutes, 30 minutes, or even 90 minutes of the open. Okay, so it's very, very important. In Europe, if you are placed in Europe, you can trade the London and New York open, which is great. If you guys are elsewhere, like Asia, you can trade Tokyo and London in your extended days. And if you're placed in Latin and Mexico and etc., the New York open is in your business day. So the first hour, as I said, is the time in which we're gonna see a possible breakdown, and the one that will give us the information that we need. Okay, so if in the very first 5 minutes, which is we have the open, okay, if we see a choppy sideways and no clear trend or momentum, then this might lead to a very choppy rest of the day, rest of the session, I should say. If up to 30 minutes, the very first 30 minutes, we have an actual clear direction, okay, something that will give an indication that yes, we are in an upwards trend, we're in a downwards trend, and etc., that could lead to the establishment of a trend for the rest of the session or even the rest of the day. So after the 30 minutes, if we see a reversal, okay, so if we see anything, okay, they are called dead candles, but a significant lack of momentum, strong pullback within the very first 45 minutes, that could raise the question whether the trend is strong, and that could raise the question whether we're gonna have a potential reversal. Okay, the whole hour, if still the trend is not clear, then that means reversion. If it's clear, then you need to double check with your momentum, and if you have a clear trend and a strong momentum, then you will have also a direction for the whole day. Okay, we have already mentioned that you should check the news, the very, very first thing before the open, right? And that's why I put also the trading journal how to set your training journals and bonus material today, because you need to be prepared before you trade the market open. You need preparation. You need to check in the previous session what happened. I mean, you need to scan your charts to see what happened. You need to check the news to check whether there is something after hours that it might affect your market open. To check also if there is something changed significantly, the sentiment changed significantly in the previous session, in the New York session, let's say, if you're trading the London one, you need to know why. Okay. Even if you're trading Forex, okay, Forex market only has one open, okay, for early Monday morning, okay, but it's still an open, so you need to be aware what happened on Saturday, what happened the previous week, how it closed on Friday, okay, and the overall momentum as well. If you're about to trade the stocks, check. Do we have any important announcement after hours? What's my Apple, for example, after hours or before? What is it? Are we gonna have any upcoming news regarding Apple and so on and so forth? Also, spot whether you have any gaps. Very, very important. Very, very important. The gaps are significantly important when you're trading the market opens, and what kind of gap you have. You can find more information regarding how to trade gaps in our webinar, which is called How to Trade Gaps. So if you visit our website, you can also watch the How to Trade Gaps. Regarding gaps now, guys, remember, traders may begin watching the pre-market if you are trading indices or stocks, okay? And see whether their index or the stock have already moved well away from the previous close on any news or correlations that we have with other markets. Some local and global markets are also heavily traded before the official stock market open. So any aggressive moves in these markets provides insights into what is possible as the stock market opens. So, for example, have stocks taken into account, it can move gold, it can move silver, it can move bonds, it can move oil, it can move dollar, it can move. Remember what's going on right now with the US indices. The US indices, NASDAQ, Dow Jones, and etc. are all-time highs. Why? Because of what happened with the AI, with the artificial intelligence boom. And that affected also the bonds. The bonds and the dollar as well. The dollar has been a bit on a correction due to all these boosts that we have seen in stocks. Everything matters. So checking where there were any aggressive moves overnight, and in this particular markets, it will give you also insights for other markets, such as the currencies and the bonds and gold. So, for example, we have what is now the all-time highs for S&P 500, right? All-time highs. Boom. What happened in this hour? This is the rally that we have seen since Friday. What's going on with the okay, sorry. Where is it? Come on, Andrea. Do we have gold somewhere or dollar? Gold here. Gold lost traction. There is an inverse correlation. Where is our dollar index? Dollar index. 1 hour. Zoom out a bit. Down. In a ranging market overall, but down, because we had a significant very attractive stock market, a very, very strong stock market. So you need to be aware and you need to spot whether there are any gaps. Don't forget the gaps. And there were gaps where did I saw the gap earlier? It was in Dow Jones. Let me double check, guys. I'm sure that I saw it. Was I cannot spot it right now. Might be Nikkei, because I was watching Nikkei, which is a 34 years high. So it might be, I might remember the gap on Nikkei. Anyway, you need to check all this. You need to ask yourself, did this market have breakout, or they had seen severe declines? If so, it's highly likely you will see equities adjust according to their correlation with those markets, like Nikkei, 34 years highs. This is because of the weak, pretty weak yen. So if you have this knowledge, you can trade your yen as well. You get my point, right? And again, always remember to confirm all these informations with your indicators. This is, by the way, put on an approach that you might consider, other than the habit that you should have your own system, your own. So I'm taking by default that you have a system and you have a plan, you have a strategy, okay? And if you have, since you have your system, you need to mark, first of all, the previous cash session open and close, the previous day's highs and lows, like I did here. Then try to find, if you don't have already, a 15-minute opening strategy. If you don't have one, check what I have put on over here. This is a 15 minutes open strategy. So we have put on the previous open and close, the previous day's highs and lows. We have marked them, okay? We are waiting to check the very first 15 minutes of the market open. And we put a mark on the very first 15 minutes, high and low. If the candles close above high in the following 45 minutes, you can take a long position. Otherwise, you can take a short position if the following candles closes below the low in the following 45 minutes. Also, your stop loss could be below or above, depending on which direction you are taking, the 15 minutes session. Very useful on this and very important in this approach would be a 21 exponential moving average, which will help you to either shift your stop loss or decide a target. And I have put some examples with the 21 moving average, posting the highs and lows, and so on and so forth. So here it is. Let me just be precise. Previous highs, previous day low, and I was waiting for the market to open, and in the first 15 minutes, it jumped higher, breaking the previous high, so I took a long position, with stop loss, remember, below the previous low, which was here, okay? And it extended higher for a while and then turned back below my 21 moving average. So this is where you should take a repositioning, or you should open a new position, but in the opposite direction. Again, here, look at that. This is the same, but in a 5 minutes chart. The first 5 minutes broken that's why it's a very, very short time frame strategy, guys, okay, for 1 minute, 2 minutes, even 5 minutes candles. So the very first 5 minutes, boom, broken. So we could take the open, we could take the entry, long entry, and you can see that you can use here as a stop loss, and you can use your ATR for targets, multiple, one or twice your ATR, or you can use Fibonacci extension for placing your targets. These are multiple targets. And over here, in which it touched moving average, it was the exit point. The 4 is the exit point of this long position, okay? Again, the very first 2 minutes, boom, breaking my previous days. So it's calling for long position, right? If you're not sure, wait for a few more minutes to see whether it will continue to the upside away of the 21 moving average. 21 moving average was pointing higher. And so that was an initial pause, but still well above moving average. So as you can see, the exit point, the exit position, to exit your position, to close your position, could be either as soon as it touched at the very first time the 21 moving average, or as soon as it touched your target areas, depending on which on your exit strategy. You can adjust your trending strategy. This is just an approach. So guys, this is pretty much it. It's a very straightforward webinar. So I have just put a lot of examples for you to study. But this was pretty much it. This was pretty much it. Gap, huge gap on open. So it's calling for a short position. It was in downgrade despite the earnings beat expectations. So that's another approach for a downwards, for a short position in the very short term, and so on and so forth. So that was pretty much it. There is nothing really else than that. I want you to check closely this approach that I have put on. Obviously, if you have your own, that's very, very good. But yes, this is the approach on how to trade the market open. So it was a short webinar, but we are done.